Thanks everyone coming online. My marketing manager, Tatiana, looked over our videos and noticed that whenever Amit and I do a video, it's one of our most popular videos. So we decided, hey, let's do another one. And then serendipitously, this wasn't planned. I literally am closing on a property today. So I finalized my 15th mortgage yesterday with Amit and his team. So I definitely am someone that have gotten multiple mortgages over the years and hold multiple mortgages, and especially at a time like this. And I'm sure Emma will attest to it. There are definitely challenges when it comes to these types of things, because the market is what the market is right now. But everything is possible. So, Emmett, I thought I'd let you introduce yourself, and then we'll just get into a conversation about having multiple mortgages and how to get multiple mortgages.
Absolutely. First and foremost, always a pleasure to be here. Alex, this is always a treat, and we don't get to do this enough. So, for those of you that know me and those that are new, my name's Amit Puri. 22nd background. Went to business school here in Toronto. I'm a CA by trade, and for the past almost 14 and a half years, I've been doing mortgages. And out of 10,000 brokers in the country, we constantly rank in the top three or four. So, that's thanks to the love and support of Alex and his team and all our peers in the industry. So we're here to help, and we'll make something complicated sound easy.
Yeah, exactly. And everything that I talk about, and if you go back to the past videos, and I start my videos off and I show the portfolio. Building a portfolio is and owning multiple properties is truly, when you do that over the long term, a fantastic way to build wealth. Now, a key component to do all that is actually get these mortgages. And how I grew the portfolio. And again, recently I did a video showing people how I grew the portfolio and the various methods that I used. Predominantly my portfolio bought with pre-construction properties, and that allowed me to scale things up rather quickly over a 10-year period. But the beauty of owning all these properties is that when I look at 30 years, all these properties will be paid off. Now, the current challenge in the market is that interest rates are high. And what I tell people, and literally got off the phone with someone today, I'm walking people off the ledge every day. Emmett, are you walking people off the ledge every day?
It's my part-time job. I think
Yeah.
I'm essentially a psychologist these
Yeah.
days.
So walking people off the ledge every day. But I have some great news for everyone on this call. And again, I got Amit here. He's the professional. He will either deny or validate my claims.
Next Wednesday is a big day, right?
It's even like when I actually did the math this morning. So I'm looking 6 months out. So if people don't know, next Wednesday is the next Bank of Canada interest rate announcement. And you'd be like, Alex, why are you rambling? How do you get just talk about multiple mortgages? But I want to paint the picture for everyone to understand where we're going in the future. So October 23rd, we have a next interest rate announcement. Then you have another one in December, then January, March, and then April 16th next year. What I can say confidently is that interest rates are going down. That is 100% happening. Interest rates are going down. Now we're just talking about the velocity of those interest rates. And I can say with confidence that either by April or June of next year, your Bank of Canada rate will be under 3%. And it's just simple math. If you have a 50 basis point cut in October, or that 50 basis point cut can be in December, either one, you have a 50 basis point cut in either one of those, then a 25 basis point cut in every subsequent meeting after that, which will happen. We are in the interest rate lowering phase. You will have a sub 3% bank rate, 2.75. And at that time, you will start seeing variable rate mortgages to start with a 3. Emmett, would you agree? Maybe.
No, I agree.
Okay, good.
And To add to it, I was at a national conference for the people across Canada, and we had the beauty of having some chief economists there from the big banks.
Hmm.
And long story short, if they drop the rate too fast,
Hmm.
it will spike inflation, and everything they've worked hard for the past 3 years would be unraveled.
Hmm.
And so
Hmm.
the general consensus was, and I was doing this while you were talking,
Hmm.
is this is how rates are going to drop.
Yep.
So instead of dropping over, which is the black line, they have
Hmm.
to do them in a staggered process.
Yep.
And so the only part that you and I, not even us, we don't have a magic ball. The only
Hmm.
part that no one knows is there is about a 3 to 4% drop expected from the peak, which was
Hmm.
7. So 7
Yep.
minus 4 is exactly what you said.
Hmm.
We just don't know if it's going to take 2 more years or 12 more months or 3 more years. It's all like dependent on how the economy reacts. But I agree with you that I'm going to say within 12 to 18 months, we are right where you just said.
Yeah, that's where when I have a presentation called make 100K in 18 months, and that is just showing the where mortgage rates will be in 12 to 18 months, and I do it at 3.5%, getting a variable rate at 3.5%, and then I show where the market will be in regards to, and I focus on condos because condos are the hardest hit right now for a number of reasons, which I won't get into because the whole presentation you can watch those videos. But where the relevance is that landlords will then shift to being cash flow negative to cash flow positive. I can pull up my portfolio and I can see where the shift happens at my variable rate interest rate mortgages when they turn from negative to positive. And when these properties turn from negative to positive, I'm not selling properties right now, but other landlords that have their properties that are negative on the market right now, cash flow negative, those properties will come off the market and they won't be selling them anymore because they're not going to sell them at a discount. They don't need to sell them at a discount.
So
So
one thing that you brought up a few minutes ago, you said, your portfolio in 30 years will not have debt on it.
no.
And that is the part that I spend most of my time explaining to investors and people buying into properties. And we can expand on this if you like. We'll use a base number of $100. If you buy something for $100, in this case, a home or a condo or pre-con, anything, in 30 years, it should be worth $120, but that debt you took on for $100 in 30 years is zero. So you gain going this way and you gain going down. And
Exactly.
people forget that there's two sides to that coin.
Yeah. Yep.
So when clients are calling literally twice a day for the past 2 years, I'm losing $700 a month on this property downtown. I got to get rid of it. Help me, refi, do whatever, take a private, do this, and all kinds of questions. And I break it down as follows. Let's say you're losing $1,000 a month on the property. Let's go even
Mhm.
extreme. I'm doubling it.
Mhm.
And let's say, Alex, throw me a number. What's the average price of a condo right now? Just any number.
Oh, let's say you go out there and get one for 550. Let's go. Let's make it easy.
Perfect.
Let's make it easy math. Let's
What
say
is that
500.
condo for 500K worth in 30 years? Throw me a number, any number. Let's
I'll
say a million.
let's say that. Yeah, let's say that.
Okay, let's say $1 million. So you have a condo worth 500,000, and in 30 years, we know that it should be worth about $1 million. We're talking 30 years, about a generation and a half. So
Mhm.
those with little kids, your kids will have kids. Like that's how long down the line it is, right?
Mhm.
And so if I say to my clients, okay, so you're losing $1,000 a month. Let's assume you're going to lose $1,000 a month forever now. So
Mhm.
after 30 years, you've put in $360,000 because 30 years is 360 months.
Mhm.
So if you had to spend 360,000 and in 30 years you have $1 million asset with no debt, would you take that deal? Everybody says yes. And
And the good
that
news,
is the long-term view that needs to be reset. And that $1,000 loss is simply temporary, and that's what you're alluding to now.
absolutely, absolutely temporary, absolutely temporary. Um,
Like anybody listening to this, if for instance I said, give me 300,000 and I'll give you $1 million in 30 years, most people would consider that to be a safe bet. So that is what this analysis is trying to do, just using a base number. And it's
mhm,
not $1,000 per door. It's much less because the payment gap that people are making, a lot of it goes towards principal. It's not all cost.
correct.
So
Yep.
just my 2 cents around why that saddening cash flow loss per month is not a bad thing. It's okay. It's just we got spoiled for the past 15 years because we were always on the other side of the coin.
Yeah. And that's where, like, you can literally go today. We can get off the call. You can go out, like, email me or book a call with me. Go, Alex. You know, this is interesting. I can give you properties today that will be cash flow neutral. That so you're negative today. I can't not have you negative today. You will be negative cash flow today. That is happening. I can't not do that. But I can bring you properties that in 12 to 18 months they will be cash flow neutral. And what you're doing is by taking negative cash flow today, in 12 to 18 months, it will no longer be negative. As Emmett said, you look at in 30 years, that property be paid off. You're not subsidizing the rent anymore after 12 to 18 months. And that property will go up in value in that 12 to 18 months. I can absolutely do that. I can forecast that. I can show you all the math. And then when that happens, the property will probably go up 100K plus. So why I've spent the first 12 minutes, we started at 12:05, 12 minutes talking about all of this, because I needed to give you a reason why you'd want to get another mortgage. Why do we want to get another mortgage? Why do I want to go in negative cash flow? Because I can't get you positive cash flow. Because the opportunity is today. Now, Amit, if I'm just a regular person, and I want to buy a second property, how hard is it for me to go get a mortgage?
My answer to that is the same as always.
Mhm.
Everybody gets a mortgage.
Everyone
It
gets a mortgage.
simply depends what bank and what rate.
Mhm.
Obviously, every client is different, every circumstance is different. Some people are working jobs, some are part-time, some are full-time, some are salaried, some are hourly, some people are self-employed, like how we are.
Yep.
Some people are on contract, IT consultants, security consultants, etc. How there is a bank for everyone. And so what most people don't know is there's the big five banks, Royal, Scotia, TD, CIBC, sorry, and BMO.
Yep.
And believe it or not, and you've seen this, we have 39 banks to
Mhm.
go get
Mhm.
mortgages from in our industry. And
Mhm.
so they're not all created equal. Some of them don't care about credit. Some of them don't care about your job. Some of them care about where the property is. So long story short, everyone gets a mortgage. It's the process is generally for a first time person doing it, my standard process, and feel free to jump in, is we look at what you own now, see how much we can take out of that property, and we apply that to the new one. That's called extracting the equity from the first property, or other word I use is OPM, other people's money. So
Mhm.
you have a house worth $1 million, the mortgage on it is 600, the bank will give you up to 800. So there's 200,000 to apply to property number two. And so going back to what you were saying, that why we spend 12 minutes, it's the tortoise and the hare, right? So
Mhm.
you've spent 15 years building your portfolio, maybe even longer actually, and you're at 15. It's the slow and steady process that helps build equity and properties. No one's going from 0 properties to 10 in 1 year. It's too risky, it's a lot of stress, etc. It's the slow and steady process of looking at your portfolio, add to it, look at it, add to it, look at it, add to it. And that also gives you the assurance that the path you're on is correct, because you fast forward a number of years and you see that the numbers are doing what they're supposed to do.
Mhm. And we know rates are going down. And again, that like I'll also say this, if you go into your local branch, just walk into your local branch to ask for another mortgage, hey, I bought an investment property, that kind of stuff, that is the absolute wrong thing to do. They don't know how to get you another mortgage on a property. And I'm not saying that, like, no, I will say like a mortgage rep, like a dedicated mortgage rep for a bank. Yes, that person can be a little more skilled, but if you just go into the branch and deal with it, you're not getting people that are used to dealing with. Like, okay, I can tell you, I cannot go into a branch and go, hey, can I get my 15th mortgage? That is like they're walking me out the door with security.
So to add to that,
They're not.
look, there's a lot of talented people out there that
Yeah,
that
yeah.
do what I do, that do what you
Mhm,
do. At the end of
mhm,
the day, I always find honesty and truth is what gets the process over the hump. So
mhm.
you brought up a good point, and I'm not to be specific, but you know, one of the biggest differences with going straight to a bank or even straight to a specialist at a bank is they have a limited toolbox. So,
Yep.
for example, this is just an example. I'm just using the name as an example. You walk into Royal Bank and you need a mortgage and you need property number three. As an example, again, it's not on Royal, I'm just using their name as an example.
Mhm.
A lot of the big five banks will lend based on something called an aggregate total. So let me explain that for 20 seconds. If everyone knows that you get some multiple times your income as a mortgage. So again, using an easy number, if you make 100 grand and you can get 5 times your mortgage, that means you get a 500K mortgage. Pretty simple. A lot of the banks out there will give you 500,000 total. They don't care if you have one property or 10. But a lot of the banks that we work with, and Alex, you've gotten these mortgages yourself,
Gotten them. Got
whether
that.
they're green bank or red bank or blue, it doesn't matter. They will do 500 per door. And that is a massive difference. So those are the tools that the specific bank doesn't have because they're not able to go to the other toolboxes. And so the analogy I use is you can't squeeze a round peg into a square hole. So you
Yep.
can't just jam it in. So having access to multiple lenders, whether you know your own people at various banks, it's to be able to get to the policies that suit your need. Does that
And
help?
those policies are always changing, and that's where someone that knows where a bank's policy currently lies, uh, like that, they'll be able to move that to that bank. And what I mean by that is that banks are bullish sometimes and banks are bearish sometimes. That's their job is to manage risk. So if they see their they don't have a lot of properties in a certain segment, they want to increase that so they can be more aggressive. They can increase their policies. If they're looking at we have too many properties in this segment, okay, we're going to change our policy so we're not taking as many of those types of properties on. That's how they manage the rest. So
Banks
when
will change
policies always change.
policies saying we don't have enough professional clients like doctors,
Mhm,
engineers, lawyers,
mhm,
etc. Now even realtors have a professional corp, right? And
mhm,
they'll create a policy for just 6 months where they will just want every professional to come in and then they
mhm,
close it.
mhm,
So like you said, they come in and out. So
mhm.
when you're dealing specifically with your bank, you only have access to the tools that they have at that moment. And those
It
tools keep switching lenders.
always
One
switch.
week
Always switch.
Scotia's doing it, next week TD's doing it. So that's where us working together, we're able to figure out where do you fit this month or this week. That's literally what the game is about.
And then also when we talk about like depending how you pay yourself, maybe you're someone that doesn't pay yourself a lot of money because you own a corporation, that kind of thing. You just pay yourself differently to manage your taxation.
Minimize your tax. A good accountant minimizes tax.
Yeah, which that can impact you on the mortgage side, but there are banks that recognize that. I can say the last two mortgages I got are through Equitable Bank. Not that I'm full out reducing my tax. I still pay lots of taxes, but it just the sheer volume of the portfolio and where I'm at now, Equitable has a bigger appetite for that than the other big five banks. So it's always looking at, okay, where can I put the property? Where can I move the mortgage? who's recognizing this type of income. As Amit said, if bank gets hot for professional corporations for a period, they want to lend to the doctors and dentists and IT
Lawyers,
professionals,
engineers,
all
anyone with a
that.
PC.
Like,
Yeah.
oh, we need more of those. So we've created a special product just for these people, and they flood those people in, and then when they got enough, they close the door. You need to have your pulse on that, and that's how you get the mortgages. That's how you get mortgages in specific situations and grow the portfolio. And again, why I'm so excited about it right now is that I see such an opportunity over the next 12 to 18 months. Again, you will be cash flow negative today. That cash flow negative will cost you anywhere between, let's say, $5,000 to $10,000 over that period, but you'll get $100,000 in 12 to 18 months. 10,000 return is 100,000 of equity, and then at the end of that period, you're going to be cash flow neutral. Like we're in a temporary period where I have a glut of real estate listings, and supply is outweighing demand, and I know the reasons why. It's so exciting. I know the reasons why, and I also know that I'm on the downward trajectory for rates. That is happening. That is happening. That's happening around the world. The European Bank just reduced their interest rates today. Was it today or yesterday? I think it was today.
I believe it was yesterday.
No, yesterday. So they just reduced their rates yesterday. Worldwide, they're coming down. The slowest country that'll reduce their rates will actually be the States. And part of that reason is that because their mortgages are different than everyone else in the world, they're the only country. Now I may be mistaken. Maybe you can find another country, but the majority of countries follow a model for mortgages like Canada has. The U.S. is different. The U.S., when you sign an interest rate, you sign an interest rate for 30 years. So they don't feel their disposable income. They don't feel the pain that every other country in the world does because their mortgages aren't renewing. They don't have they don't have the renewal cycle, which is eating into their disposable income. That's not
And
happening.
the other big kicker for the States is the mortgages are tied to the address, not the person. So sometimes when you buy a house, you're picking up an interest rate from years ago that you don't have access to. I've seen some interesting things happen down south of the border.
Yeah, and again, they're flooding their economy also with spending and everything like that. But they are also going to be coming down with they did a 50 basis point cut already. So we know worldwide that rates are coming down, and that's where the opportunity is today to secure these, because when rates go down, values will go up. There's the old adage that but date the rate, marry the house. I in my news in my blog posts or my market reports, I've changed that. I say date the payment, marry the opportunity, because we're investors. We're not going to marry the house unless you're living in the house. So you date the rate, which we know is going down, and then you marry the opportunity. And that's where working with a professional like Amit, having access to the 39 different lenders, and then on top of that, you get into the private lenders, B lenders, all that kind of stuff. By the way, I have done every single type of lending that there is out there. There is a purpose for every type of lending out there, and I've done every single one. And that's where I see the opportunity right now. Why did I go to Calgary in 2019? Because I saw, hey, prices are way down here. I see prices going up. Hey, and guess what they did? What do I see right now? I see prices in condos in Toronto, and specifically downtown Toronto. They're down here, and I've done the math. I'm like, well, they're going to be cash flow positive at 3.5% interest rates. So when we hit that, we're gonna have a reduction in condos for sale, and we are also going to have an increase in sales, and values are going to go up. It's simple math, and we know all of this is happening. This is why I'm so excited about the opportunity, educating everyone, get more mortgages, because the opportunity is right now. The blood is in the water. And is there blood out there? Because you're the one talking to the people that are crying every day. There is blood out there. I have the conversations, stupid. You really have the conversations because you see people.
Yeah, we're gonna need somebody to come split the seas. It's burning. People are not doing well.
Oh,
And the point you raised about pricing, like again, going back to our overall example for everybody listening, you know, if you Alex said you'll lose 10 grand. I was doing the math on my calculator while he said it. That's over 18 months. That's $13 a day. It's a cup of coffee, maybe two, maybe a combo somewhere. That's what you have to give up a day. Now that loss is for 18 months. So you're like, oh, so I'm gonna lose $10,000. I agree. But that condo that's worth 500, I would say is gonna go up 20% by the time the rates come down.
yeah,
So that
yeah.
condo is worth 620,
Hmm.
600, right?
Hmm.
So value goes up $100,000. It costs you 10. Again, anybody listening to this, if you gave me $10,000 and I said, I'll give you 100,000 in 2 years, would you take the deal? That's the answer you have to answer for yourselves.
You know, when you said $13 a day, I just thought in my head, brown bag it every day. Just don't
Yeah.
eat out for lunch anymore. Brown bag it. Just make a sandwich every day or soup or whatever you want to make. Do that every single day. And at the end of 18 months, you'll get a check for
I
$100,000.
agree.
You eat a sandwich every day, and then you get a check for 100,000 at the end. Wow, that is simplifying right there.
It's what I've learned, and I've been at seminars where there's companies out there that own 1,500, 2,000 doors. Like
Mhm.
that's their business.
Mhm.
And when they talk about cash flow issues with investors, it comes down to, can you give up a meal a day outside? Like, can you give up a combo? Because when you break down the math, okay, it's costing me $500 a month. Okay, that's $13 a day. That is
Mhm.
not a number that should bankrupt anyone. But when you think of it in the aggregate, I don't want to lose 10 grand. That doesn't make sense. But again, would you lose 10 grand to have the upside potential for 20% increase, which, like you said, once people are neutral, listings are off. Now that it's going to be seller's market again, then price wars will start and the price starts to rise. I mean, it's always going to go up,
Yeah.
down, but the overall trend is up, right?
And,
So
and I'll add this as well. And you're the professional on this. When you look at there'll be more buyers come to the market 2025, 2026. But part of it is that more people are going to qualify for their first property because as rates come down with the stress test and everything, that just allows more people more room to buy property. So literally, you're increasing the credit supply, you're increasing the number of buyers that can buy a property, which will then put more pressure on the supply of houses. That's where the opportunity is. As rates come down, it's not just impacting investors, it's impacting the ability to qualify to buy their first
it's
property.
100% correlated. Like there is no doubt. Everything you just said is 100% true. So again, putting some numbers to it. 10 years ago, the average person got 10 times their income as a mortgage. 10 times. So the person making 100 grand got a million. At the bottom of the market, which was about 8 months ago when rates were at a sky high, it was 4 times, which is nothing. The $100,000 earner gets 400 grand. Right now, it's back to about five and a half, six. It has to go back to the 8 to 10 times. When
Mhm.
it goes back to 8 to 10 times, you're going to see a flood of buyers. And when a lot of people are chasing the same thing, price goes up. That's just economics 101. So
And yeah, go ahead.
is it going to go up? Yes. Is it going to go up in 2 days or 2 months or 2 years?
No.
That's all we don't know.
Yeah, we're gonna be that 18 months to 12 let's say 12 to 24 months. I circle 18 months in there. And the key thing is too, and not just me saying this, read Benjamin Tall, the chief economist for CIBC.
CIBC, yeah.
Condos are bad right now, but when you look at what's going to happen in 2026, 2027, 2028, when you hit 2028, there are no new condos coming. None, none. And okay, maybe a few, but
You showed me that chart, the one
yeah,
where it's like only a few
just
thousand units coming online. Yeah.
drops right off a cliff because the whole funding model to build condos is based on pre-construction sales. Well, pre-construction sales haven't existed in Toronto for the last or the GTA for the last 2 years, and that's going to still continue on until 2025 as well. That market's dead. So you can't you literally have no product coming online after 2027. Again, like maybe a few thousand, that kind of stuff. So you have no new product coming on. Then you're gonna hit severe supply issues. So that's, again, we just got to look in the future. You look at the future. What COVID did was this, right? So now we're here, and then we're gonna have more reaction until we get to the back to the norm. So right now we're down here. Saw in the stock market already. Stock market already recovered. Now the real estate market's taking this bumps. The freehold market is already recovering. Condo market is going to get lags the freehold market usually 6 to 8 months. Everything is going to work itself out. You just got to take advantage of the opportunity when it's right at the very bottom. So Amit can get you the mortgages, even if they're negative cash flow. That's not an issue. Your why would I want to get multiple mortgage right now? Because that's your opportunity in the future. Lower rates, constrained supply, more buyers. That's all happening. And I'm screaming it from the rooftops. I'm screaming it from the mountains. That's the opportunity that I see. And again, you honestly don't need to run out tomorrow to do this. But you need to call Amit tomorrow to get your ducks in a row so that you can take advantage of the opportunity over the next few months. Because that's where it is. Even in the Globe today, there's an article about parents are out there buying condos they've always been out there buying condos for their kids, but now they're going out there and they're actively hunting, going, hey, I could pick up a condo for my kid and help them with that, because now was the time. I'm right at the bottom. They're going to make a great they're going to do
It's
great.
funny you say that. I've had countless calls in the past month of people trying to buy condos and houses for their kids who are still children, saying this is the time to buy. And
Yes.
again, no one has a magic ball. I don't have any predictive methods, but no one can time the bottom of the market. But we are probably either in it or it's about to turn. I don't
Mhm.
know if you agree with this, but I think after the holiday season, we're about to go completely upwards. Like at some point in March, April, May, June, the market's going to just go this way because the
Oh,
rates are down, people are back, people need to move. It's going to change, and that's going to start the slide upwards.
well, if you just look at transactions, like average transactions for a year, be in the 80s. So what the peak of the market, we did 121,000 transactions. Now we're in the 60s annually for transactions. That means we're going to go back. The people need places to live. Like there's that pent up demand of all those people that are going to come back into the market. What's holding people back? Interest rates. Are they going to go down? Yes, that's happening. These are all things that we can see in the foreseeable future. All these things are going to happen with certainty. Can we say it in regard to it's going to happen tomorrow? Is it going to happen in 1 month? I can't predict it to the day, but I can predict it in 6 month increments. And when we work out, like, okay, well, what does a month cost me? If a month costs me $400 to $500 or $250 or $300, that's a nominal sum, because we know if it didn't happen that 6 month increment, it's going to happen in the next 6 month increment. That I can say with a fact, and that's where the opportunity is. So what I'm going to do now is I'm going to open up, like, that's just me rambling on about opportunity. Amit saying, hey, we can get you mortgages, like that's not an issue. We know the lenders out there that are going to look specifically at you and the property and the value of that. What, not specifically the property, you still got to have the income for the property, but they're not going to take into your other investment properties. There are ways to do all these things
That's right.
there.
And
But
just
let's
to
go.
close up that thought you
Yeah,
had, like when people hear 120,000, 60,000 in the Toronto, I think you're talking about Treb, yes?
yeah, yeah.
So in the Toronto real estate area, there's an average of 5 to 6,000 sales per month, sometimes up to eight. At the
Mhm,
peak, it was 10,000 a month.
mhm,
What
mhm.
people don't realize, no matter what's going on in the economy, whether there's blood in the water or people are laughing, there is always going to be transactions. Why? There is a natural movement of people.
Have to.
People have to move here, people have to move away. Your family's growing. You have to move out of a condo, go into a townhouse, or people in a townhouse got to go to a house. And people are downgrading because they're retiring. So no matter what, I don't have the stat in front of me, but I think the lowest I've ever seen is 3 or 4,000 sales in a month. Like There is
Mhm.
just a natural amount of transactions that has to happen no matter what, because people are moving for life reasons. Your kids get into school. I just had a client who moved across town into North York because their kids got into a really good private school there. Not very expensive, but they had to move into the area. They had no choice but to buy what they bought and sell what they had.
I had the exact same scenario. Clients this summer had a house on the west side of Toronto, and his job moved him to the east side of Toronto, which could be like is basically another province with traffic. And he wanted to improve. Really wanted to improve the school district. So we he bought the house first. His current house was really soft in the market. We ended up renting his current house out. We'll sell it at some point in the future. Didn't regret a thing because he's like, I did this for my family. This was the timing of it. Didn't work out for the sale of my house. That's fine. That's rented out. I have the other house. We're so happy. We glad to made a move. That's the underlying. People aren't moving. This was not a financial move. This was a life move, and
That's
those
correct. It happens.
always
People have no
always
choice
always
sometimes.
exist. Um, oh, I had a great thought now. Oh yeah, now I wanted to say, going back to condos in downtown Toronto, and I can say this with again absolute certainty because in my what I'm lucky to deal with, and Amit as well, is that when you sell investments or you sell roofs over heads, that kind of thing, everyone needs that. It's a fun Pavlov's hierarchy, and each shelter is one of them. So that I talk to C-level individuals that are in executives in downtown Toronto. I can tell you that they want their people back in the office as well. Like that is what we've reached now is, and also through in I do a lot of entrepreneurial coaching, that kind of stuff, and this is in the room in the entrepreneurial coaching as well. So we had our work from home, and that the structure is still going to exist. Work from home is here to stay. There's no question about that. But it's not going to be work from home 5 days a week anymore. That is past, and executives, managers, C-level want people back in the office because this is where it's lacking. You can go back to my videos and you can see where I talked about this before as well. Like during COVID, I'm like this, you'll have a swing back. Is that they've completely lost collaboration. They've completely lost collaboration. So yes, there were efficiencies built in by people working at home and that kind of thing, and you could survive off of that. But your collaboration and moving things forward, your teaching of the next generation of workers, the people that are replacing, that has completely fallen off a cliff, and they want to get that back. So when I look at downtown Toronto, again, is that coming back tomorrow? It's not. Well, it is coming back now, but that is going to come again in stages itself as people come back to the office, and people are already back in the office. More and more people are going to be forced to go back to the office. What does that mean? More people are going to move back downtown. You're going to have more
That's
activity
correct.
back downtown. That is happening. I've Some of the people on the call may have already experienced it, or are in situations where, yeah, like our company, we're moving people back. That is 100% happening. I've heard it from people that were on the other side going, that working from home is great. We got my team, everything like that. But they're like, wow, we're really missing out on this collaboration aspect. The left hand is not talking to the right hand. We're starting to see things break down now.
That's
So
right.
there were benefits, but now those benefits are becoming detrimental because the left hand isn't talking to the right hand, and you're not training your next generation of workers. That is happening. And guess what? Well, where are these people going to live? They're going to live in condos in downtown. And by the way, when we made the joke about like a person in Toronto moving from the west end to the east end, traffic ain't getting any better. So you're better off commuting with your two legs, because that is the best way to move around. And what are you going to have? You're going to have people move downtown, or you're going to have people get Pierre de Terres going, hey, I'm in Oakville. I'm going to stay in Oakville, love Oakville, but I'm going to have a condo that I'm going to live in 3 days a week because when I'm in the office, so I don't need to deal with traffic. These are the things that are going to happen, and that's where you're going to see a bump in activity. That's again coming in the 12 to 18 months. So what I'm going to do now is I'm going to open the floor, because we always get great questions. People ask amazing questions because they get in their specific situations. So I'm going to open the floor. to people if they want to have any questions about getting mortgages or current mortgages, everything like that. So here's one right here. I have two mortgages, 3-year fixed maturing in August, November of 2026 at 5.87 and 6.2, both with a balance of approximately 490K. When do I refinance to reduce my negative cash flow? Great question. That is a great question.
I guess let me jump on that.
Can you see the
Yes,
question as well?
absolutely.
Oh,
Yeah,
yeah. You
absolutely.
jump in it.
So for the person that posed it, we got to go back to the fundamentals just for a moment. You mentioned something very critical, which is it's a fixed mortgage.
Mhm.
For those listening, there's two types of mortgages. One is fixed, one is variable. Fixed means the rate never changes. Variable means it goes up and down with the economy. Here is the problem with a fixed, and those that know me know that I generally will lean towards variable on the average. Let's use an easy example. On $1 million mortgage, the penalty in a variable is about $5,000. It's manageable. It's not the end of the world. In a fixed, the penalty is 9 times that number, 45 grand. And so the challenge is not the cash flow. The challenge is determining, is the penalty worth the breakage of that mortgage? My guess, looking at the timeline and the amounts, penalty could be anywhere between 12 and 15 grand on this mortgage. And so if you're willing to change those balances to 502 to gain cash flow, and we can analyze it to say, look, it's costing you 12 to break it today, but you'll be ahead by 13 over the next 5 years. Well, now we just neutralize that penalty. So the answer is it really depends on the penalty because cash flow is one part of the equation.
Yeah, I absolutely agree. And that's where like everyone right now should be signing variable rate mortgages. Um, and when I looked, I do have some fixed rate mortgages that I took. So I got a number of mortgages over the last couple of years, and that's some of those fixed rate mortgages. I'm like, okay, I'm just gonna hedge my bets. So I signed 3-year fixed year mortgages that are going to be maturing in 2026. I'm in that pool as well. But I knew that the mortgages where I may transact on the properties, those I definitely kept in variable. So just also wanted to say, when you sign these mortgages 3 years, so you sign those in 2023, yeah, we didn't know when rates were coming down. It was a scary time, and your variables weren't looking very good then. So I'm just giving you a pat on the back saying don't worry about it that you signed fixed rates then. You're whether you break the mortgages and get into a variable now, or whether you decide to wait and get into a variable in 2026, you'll end up being okay because these are all short-term problems.
So something that I've learned from my prior career, because before being in mortgages, I worked at TD in finance and helped manage interest and all that kind of stuff. So long story short, the fixed rates are priced knowing that they will be in line with the variable, the whole concept of weighted average cost. So for those that don't know what that means, so for example, just taking the numbers from the person that posed the question, the pricing was 5.8 on their fixed. If you actually look at the 3-year trend of variable, I bet you it averages out to 5.8 or less. And so from a bank perspective, here's a couple of stats. Variable outperforms fixed 90% of the time. Now, there was that period in COVID where people got some cheaper rates, but that hadn't been seen in a generation or two.
Mhm.
And so 90% over the last 75 years, variable has outperformed fixed over the 5-year period. You may win in the first few years, lose in the back. You may win in the front and or lose in the front and win in the back. But on average, especially for investors, Alex, I think variable's important because it gives them the
Absolutely.
flexibility to make moves. If you
Yeah.
have an investment property and the mortgage is with BMO and you fixed it, and all of a sudden there's a program at TD where you could up it by a couple hundred grand, you are going to be hesitant to do it because your penalty is 10,000. But if the
Mhm.
penalty is only 2 grand, all of a
Mhm.
sudden those investment moves are less of a material issue in your mind. So I'm not against fixed, just please be cognizant of what the pros and cons of each side are.
Absolutely. So we have another question here. If you already have several mortgages in the bank, see that you're leveraged. What is the process to get additional mortgages? Is there a specific ratio the other banks look at? I can tell you back in the day, when policies change. One of the big five banks didn't care what mortgages you had with other banks. They wouldn't even look at those. They just cared about the mortgages that you had at their bank. So the answer to that is the ratios that they're looking at. It just depends on the bank's policies and if they care about the other mortgages you have with other banks. Emmett, I'll let you go deeper into that.
Quick answers, everybody can have up to 40 mortgages. It really depends on which bank, and as long as you have the down payment and the qualification. Every bank has a different policy. Again, some banks allow 3 properties, some 4, some 8, some 16, some 40s. There are some banks that don't care how many properties you have, they will give you another 4. So every lender is different, every circumstance is different. So to answer Don's question, we would look at the circumstance and say, here are your options. Like I said, everyone gets a mortgage, just depends which bank.
Uh, there's one just very specific about numbers, that kind of stuff. So, I'll let you reach out to Emmett directly on those because that's very specific to your situation. Um, there's more details in that. Just he's wondering if he should take money at a specific rate from a specific bank and that kind of thing. So I'll let Emmett. Emmett, maybe you want to maybe if you type to him, you can actually type to him. Maybe get some more details. Uh,
Absolutely.
I'll get to the Scotia question in a second because Emmett can answer that one, but I'm going to let him answer the specific question. Here's another question. Firms seem to be keeping the hybrid work model, and I see so many people coming in on the downtown core via GO train, and they're okay with the commute. So I'm not certain these people want to stay down in the downtown core. Are there more opportunities outside the downtown core? I will tell you right now that there are lots of condos for sale, whether it's in the downtown core or outside the downtown core. I just see the most pain in the downtown core, and that's where I see the most opportunity. As well, when I see the new supply of condos coming in online, we had a lot of new condos come in online downtown Toronto, but that will dissipate starting next year. Specifically downtown, a lot of the new completions that are actually happening out in the suburban areas for condos in the future. So that's where I know there's going to be a supply crunch downtown sooner than there's a supply crunch in the suburban areas. But I'll tell you, there's opportunities right now everywhere.
I'm seeing certain pockets just fly. Nothing stays on the market a
Yeah,
couple
yeah,
of
oh,
days. There's
there's always
some
one.
pockets that things are sitting, and you probably have peers and colleagues like if it's priced right and in the right spot, it goes. It's really just a matter of correcting the mentality of the sellers, right?
Okay, so I'll leave out some information on this, but I have 2 variable rate mortgages. For the last 18 months, the mortgage payments have gone up. All the payments have gone to interest. It also gave me negative cash flow. Both payments are due to renew in August and October of 2026. Should I hold on the existing variable mortgages or break them? Well, no, you're going to keep them because that variable rate is going to be going down. And it's going to be going down all throughout 20. It's going to go down next week. It's going to go down in December, and it's going to go down all 2025. So again, you've already had peak pain. We've been in peak pain. The recovery of those interest rates all happens this year and into next year. So no, you wouldn't break those because you'd just be replacing those into another product that is going to. I would tell you do it in a variable rate mortgages. So if you have a variable rate mortgage, you want to stay in that variable rate mortgage.
But there's also a new feature from some of
Yeah.
the banks, and this is something that we've started asking all our clients.
Mhm.
So again, everyone understands fixed, variable. Fixed is the same, variable it fluctuates, just like um, Julie just mentioned, with
Mhm.
payments going up and down.
Mhm.
There's a new thing called static payments.
Mhm.
So banks are offering variables that actually don't change anymore.
Mhm.
So
Mhm.
all that does is, out of $1,000 payment, if it's 500 mortgage, 500 interest or principal and interest, they're changing the interest to 700 and the principal to 3. So for those people looking for the hybrid advantage of both, you can get something called a static variable payment. So that's an option that exists now.
Here's a question that'll go specific to your expertise. Does Scotia offer penalty-free renewal 19 months before maturity? How does this work?
I'm not aware of Scotia offering a penalty-free renewal, but they will allow you to port the mortgage into a new product, or you can get an exception if the application deserves it. Like it's not something that is publicized or that's offered, because otherwise everybody would break their mortgage. So I think it depends on the circumstance, but you can't just go 18. The only thing that could be happening here as I'm talking it through is you can switch from a variable to a fixed anytime. So that's like a renewal option. But if you're in a fixed, I doubt that they would let you switch it to a variable because remember, the fixed is what makes money for the bank. So
Mhm.
they're going from variable to fixed is allowed. You got to ask yourself why that is. And going from fixed to anything else is not. So um, it's got to be some sort of hybrid reason. There's no blanket, you get to renew at 19 months. That doesn't exist.
And yeah, definitely don't renew in don't go into a fix. Don't do that.
Please don't go into a fix.
Don't do that. So everyone, thank you so much for coming on the line. We're coming up to 1 o'clock. This has been recorded. This will get sent out to everyone. You'll have my contact details. You'll have Amit's contact details. So if you want to take advantage of the opportunities on the market, happy to discuss those. If you have mortgage questions, whether it's renewal, whether you have a mortgage coming up, or you want to get pre-approved to take advantage of opportunities, Amit and his team can definitely help you out. Oh, we got one question coming in through here, so let's get that last question. Oh, I know you feel passionately about
This
this.
is this
This,
is the question
this is
of
your
the
passion.
ages.
This is your passion. Hi, Emmett. Is it better to get a corp mortgage or personal mortgage? Because I have 4 mortgages at Scotia and CIBC.
I thought you were gonna take it for me.
Oh, well, here I'll answer
I'll
this.
answer it too, but you and
Uh,
I have interesting perspectives on this.
so, well, we're aligned in that if you're just a T4 individual, then no, you just buy in your personal name. If you have an operating company that you have excess funds in that you need to invest. So I'll give an example. If you're the doctors we were talking about, a dentist, you have these professional corporations where you're building funds up, then there's a tax advantage to move money from that to a holding company and buy real estate in the holding companies. So then you'd be buying in a corporation. But if you're just a T4 individual buying into corps, there's no tax advantage to you. It's actually an expense because the mortgages do cost a little bit more. They do charge the banks will charge a little bit of premium, not huge, but there's a little bit of a premium for no other reason because they can. The little bit of a premium that a bank will attach to a corp mortgage. And not
Plus accounting fees and other
all
things.
the accounting fees.
Yeah.
Now, accounting fees are
Yeah.
huge every year that you have to pay. So there's expenses to running them. But if you have an operating company, it makes sense. But again, if you're just T4 to individual, it wouldn't make sense for you.
Correct me if I'm wrong. I think years ago we did a whole seminar on
We
this.
did a whole
Yeah,
whole
we
whole,
did.
whole big seminar. Yeah. So
Yeah. So
no,
Vicky, long
14
story
months.
short, it depends on your circumstance if you need a corp or not. there there's misinformation in the market that everyone needs a corp, and it always comes down to can you move the money in a tax efficient process from an operating company to the holdco. But then the other reason, and this is the other side of the coin, is liability. People think that they should own rental properties in a corporation, but there's a whole thing to that where there is no liability to you when you own a rental property. There's OHIP, there's condo insurance, there's content insurance. And so there's a lot of misinformation out there on which one is advantageous. Should some people have it? Absolutely. Is it for everyone? No. I think that would be a
I'll
fair way.
I'll also add too, because this was new to this year, literally, that if you own your real estate in a corp, and this is a gift from the government, if you own the real estate in the corp, your capital gains are now taxed at your capital gain exemption has been reduced by 16.7%. So before you have a 50% capital gain exemption. Now your capital gain exemption has been reduced significantly. Also on the personal side, but that's only for a capital gain above 250,000. But on the corp side, it starts at zero. So there's a tax advantage for you to own it in your personal name when you're going to sell and disperse the property. Uh, Now that all being said, it's if you own an operating company, it makes more sense still how you're moving the money around and doing things. So it depends on your circumstance. But now you are being penalized by having a reduced amount that you can use a capital gain exemption for when you sell the property. It
There's
sucks.
also countless maneuvers and
Yeah.
strategies to accomplish what a corp offers and own it personally, and vice versa, own it in a corp and gain the benefits personally. So you and I could have another 45-minute seminar on
Oh,
this, no problem.
oh yeah, and then you get into bear trust, everything like that.
I
Long,
was
long.
literally avoiding that word, but yes, once you start doing bear trusts and things like that, everyone can gain from the benefits. It just does it make sense for you? That's all that has to be determined.
So that one there, loaded question, but glad you answered. Glad you answered that. Or glad you asked that, Vicky, because we usually get a lot more corp questions. But yeah, glad you asked that. So it's case specific if you're going to buy in a corp. So I'd say reach out to Amit when you get the summary email, and then him and his team could book a call to see if it makes sense for you. But everyone, thank you so much for your time, and we will talk to you again soon. Amit, again, thank you so much
Alex, my
for taking the
pleasure as
time.
always, brother.
And we'll talk to everyone later. Okay, see
Thank
everyone.
you.
Bye bye.